Good afternoon, everyone. My name is Sriram from the Commodity Research Desk at Reliance Securities. Welcome to the weekly market updates. So, beginning with gold, international spot and domestic gold and silver prices retained its shine across the safe haven world last week. Gold outshone silver, but overall both gold and silver gained last week. Again, contagion worries about from the Middle East latest war and the Fed's hesitancy to raise US interest rates anymore sent investors towards the bullion prices. Additionally, the combination of geopolitical and economic uncertainty, both which could have implications for the inflation and interest rates, also increased the safe haven appeal of gold and silver last week. The dollar index and the bond yields eased from their highs made in the previous week and also lent support. But the latest speech from Fed Chair Jerome Powell last week was slightly dovish. He said that the central bank is committed to bringing the inflation down to 2%. But he also added that the future monetary policy could be data driven, and the key data points will be this week the PCE inflation. So all eyes will be on that. Several other Fed policymakers also have been in force last week, with many not ruling out additional hikes but also reiterating the importance of data going forward. So looking ahead in the coming week, we see the key trigger for the markets will be the data. Of course, elevated US bond yields will cut demand for the bullion, but attention will be focused on the US GDP for the third quarter, along with PC price index, which is the Fed favored inflation gauge usually tracked by the Fed, along with personal income and personal spending, and that will be the key triggers for the bullion side. This will also be followed by US durable goods orders and PMI numbers this week, and that will also move the markets this week. Other key data include the ECB monetary policy meeting outcome this week on Thursday, and along with that we have the global flash PMI numbers, which will also have an impact on the markets going forward this week. Downside can be capped if the Middle East tensions escalate further, but current mood in the main is mainly driven by the prevailing risk on and risk off sentiments from the Middle East war, and as such situations can keep evolving going forward, and that will also have a key trigger for the markets. On the charts for the near term, we see 60,000 remaining a key support for the domestic gold futures, and only close below that we see prices will move further lower towards 59,400 or even lower. But if the market consolidates above 60,000, then I think further upside cannot be ruled out towards 61,100 going forward in the coming week. In the overseas side of things, the range for COMEX December is anywhere between 1950 on the lower side to 2010 on the higher side of things. Moving to the energy side of things, starting with crude oil prices continue to gain last week, underpinned by ongoing supply risks as the US-Hamas conflict continue to escalate. Prices also found support after the bullish EIA report, which showed crude supplies at Cushing, which is a delivery point for the WTI, dropped to a 9-year low, along with fall in crude oil inventories, which also remained on the weaker side last week. However, new supply expected from Venezuela after the US lifted sanctions on the country capped further upside in prices. Additionally, a small technical correction was also witnessed, which also kept further upside capped. Meanwhile, on the gas side, international and domestic gas prices tumbled last week as price supportive retreat in domestic in US gas production during the early October appeared to be over for the gas markets. Furthermore, weekly EIA gas inventories rose by 97 BCF in the latest week, much higher than expectations, and this also pulled prices lower. Looking ahead for the coming week, we see markets have started slightly on the weaker note, and we see market remaining under pressure if the weather remains unsupportive. Weather continues to dominate the markets for gas and will continue to dominate the headlines over the next couple of weeks. Cooler weather front will support prices, but hot temperatures going forward in the US will cap any further upside. So markets can remain range bound going forward. On the charts, we see gas prices remaining anywhere between 265 to 290 on the domestic side of thing. In the international side, we see $3 to $3.5 for gas. On the oil side, oil has started slightly on the weaker note. Bloomberg reported that that Israeli army will delay a ground assault on Gaza under pressure probably from the US side of things. But the key trigger will be the Middle East tensions, and if anything escalates between Israel and Hamas going forward in the next week or so, we see further uptick for the crude oil prices. Diplomatic efforts were taken last week to calm the tensions, but the question though now is how many days of relative calm could this be in this conflict before the next headline of an escalation sends prices higher. So overall markets or investors will remain cautious and will be keeping a key eye on that. Apart from that, data will be key. The inventory data due tonight will be a key trigger for the market. So the markets will be looking at to that as well, and the GDP numbers from the US will also have a small impact on crude oil prices. So crude oil also will remain range bound, but the bias is slightly on the negative side of things for this week. Finally, on the base metal side of things, copper gave up gains to settle weaker last week as the uncertain outlook on global demand weighed against the evidence of slightly tighter supply. Moreover, upside was also capped due to a prolonged Chinese property downturn and stalling economy from the top consumer. Earlier, though, copper had recovered, supported by signs of stabilizing Chinese economy. Data there showed that Chinese GDP was slightly better than expectations, along with slightly better than expectations on the industrial production and the retail sales side. So some recovery or some signs of resilient demand can support prices going forward. China's robust September commodity imports also boosted investor confidence that things may be turning back for the good for the metal markets in that country. So markets did find some support on the back of that, but looking ahead, key trigger will be the again the data side of things. Again, copper could remain range bound with a slight negative bias in the coming week. Again, worries about higher interest rates and sluggish global growth will continue to dominate headlines. Additionally, stocks on the LME and SHFE have been rising, and further increase in stocks there in both warehouses will continue to keep upside limited. The key trigger from the data perspective will be the Chinese industrial profits this week. A weak number will weigh on sentiments, but a slightly better than expected numbers can support prices from current levels. In the US side, as I mentioned, GDP numbers along with durable goods orders and PMI readings will be the key trigger for the base metals. On the charts, we see MCX copper November contract remain anywhere between 695 to 710 in the coming week or so. So that's it from our side. Thank you very much for watching. Have a pleasant day and a week ahead. Thank you.